Hey everybody, welcome to the Rochester Real Estate Show. It's Jason Mancuso with the Anthony Butera team at Keller Williams Realty, and special guest today, the lovely and talented Lisa Roberts from Premium Mortgage. Thanks for joining us. You've done this before. It was a while back.
Thanks for having me. I have. This is a little less intimidating. I did it when you guys were like on the radio show in the studio.
Yeah, that was way back. I
Long time
think
ago.
you did one at our old office too. But yeah, you're a seasoned guest at this point. So we're overdue to get you in based on everything that's been going on this year. And, you know, it was kind of the last couple of years in the market, it was almost we took it for granted, right? In terms of like how low the interest rates were.
Yeah, absolutely.
And how much, you know, I mean, you're not that your job is easy, right? But it's just like, yeah, you got a great rate, and let's lock it in and get you in your home, right?
Yeah, I think we've been spoiled for a few years.
Super spoiled in this market in general, right? Like as an aside, like, I mean, we've talked about it before in terms of these sellers. You're selling with, 20 offers to choose from. Your home sells in a week after, by design with delayed negotiations and a deadline, and then you just pick the best one.
Yeah.
And buyers, like, yeah, I mean, it's been a tough market in terms of multiple offers and over asking and high numbers, but super low interest rate. So here we are today, coming up on November 2022. Interest rates are the topic of the industry, I would argue, right?
Yeah, definitely. I mean, and I don't think any of us saw them going to the level they are so fast. It just happened so fast.
If you would have told me a year ago that we'd be looking at the rates that we're looking at, now don't get me wrong, didn't expect this run to last forever, right? But if you would have told me that, like you just said, the extreme rise that's happened over the course of this year, I would have told you we'd all be pushing a panic button.
Yeah.
And we're really not. I mean, don't get me wrong, like the market, transaction-wise is going to be down once the stats come out. I mean, they're already coming out for 2022, but there's going to be an adjustment to the market. But, I mean, we're not feeling it in terms of like doom and gloom and panic, right?
Yeah, I would agree. I mean, I'm actually surprised by buyers' reaction. Like, they're calling, update their pre-qual. Last time I pre-qualified them, they haven't found anything. They were maybe in the 4s. Now it's 7s. I mean, granted, yes, the payment's higher, but they still need to buy a house. And they're really, I'm like I said, I'm surprised by the reaction. They're like, okay, these are what the new numbers are. I mean, obviously some people are impacted a little bit more where it is affecting their buying power. Other people, not so much.
Yeah, and don't get us wrong. We're not sitting here saying like the demand hasn't been reduced in comparative to the 2020, 2021,
Sure.
Right? With just the lowest rates ever and, high demand as a result. But there's just enough people that are always going to need to make a move for whatever reason. It's still happening.
Yeah,
right?
Absolutely.
So,
people still need to buy homes and start families. So definitely buyers are still looking.
So you just walked through it a little bit. I mean, the mindset of the buyer isn't like, they're aware. So it's not like you're having conversations where somebody woke up from a coma of the last year and like, what do you mean the rate's 7%
Right.
or has risen from 3 or 4%, right? So they're aware, and there's not like a ton of sticker shock to the new payments, or I'm sure there is in cases that takes them out of the game, but overall, like, it's manageable still?
Yeah, I mean, as you know, any buyer out there has probably kind of been looking for a while. I mean, it has been competitive. So if they haven't found anything, they're watching the prices, they're watching the rates. So they're definitely not shell-shocked by any means. Any new buyers that are just getting into the market, I mean, they maybe have no idea that a couple years ago we were in the 3s. So
I mean, that's good perspective in terms of if somebody's just starting off now, like they don't have the callus or whatever you want to call it built up from the last couple of years if they've been looking that long and seeing the difference in payments.
Right.
I mean, I wonder like how much of what the conversation we're having right now in terms of this not being a doom and gloom subject, I wonder how much of that plays into our local market with the price points that we have in comparison to like if you're in, Southern California or wherever that's like, $900,000 average price point compared to $200,000.
Yeah.
Whether the podcast with a real estate agent and a loan officer is totally a different tone on in other markets.
No, you're probably 100% right. I mean, in some of those markets, it's probably really unaffordable at that price point. But like in Rochester, I mean, even though our home prices have increased, they're still so reasonable compared to certain parts of the country. I mean, it really is an affordable place to live.
And that's part of why I'm not pushing the panic button on my end. It's just, there's always going to be the reasons, death, divorce, babies, marriage, job change, relocation, raises, etc., that are going to, cause people to move.
Right.
So, it's a stable market here, and I would predict that it remains so.
I would agree.
Predictions are dangerous.
I mean, I don't think we're going to see these rates forever. They will come down. I think once inflation gets under control, we will start to see the rates come back down.
Yeah. And, we've, on other episodes, we've beaten it to death at this point in terms of like why this is happening. So, I mean, what I wanted to get Lisa on here today for is kind of more specifics on like the actual, some breakdown of the numbers, but then also like, okay, how can you get creative around combating this more or less? Mm-hmm. So where were we at about a year ago? In the fall? I mean, high threes?
I would say high threes, low fours.
Yeah. And now
we're probably 7%, low sevens. I mean, they kind of fluctuate.
Yeah.
High sixes, low sevens.
Before we get into that, like that fluctuation aspect is super important to address quickly without getting like deep dive conversation. But I mean, what do you like? Let's just say the month of October. Like, I mean, we've been all over the board. There were like some panic of like, oh my God, are we going to hit 8? Right?
Yeah.
To like low sevens, mid sevens. Like, it's just varying in, eighth of a point, even half of a point increments at times, right?
Yeah, it's been crazy. I mean, one day, I've been doing this for over 20 years, and never, in the history that I've done this, have we seen such a jump in one day. I mean, normally it's an eighth of a point here and there, and that kind of happens for like a few weeks, and then maybe you'll see it go up another eighth, maybe a quarter, but you're right. In one day overnight, like we've seen a 0.5% increase. I just think there's so much volatility that, the lenders that are pricing these loans, they're trying to figure out, like what's happening, what's going to happen, what's the Fed going to do. So it's just been all over the place.
So, I mean, your sense of urgency with your clients just has to be like, you have to create that to be through the roof, right? Meaning like if you get an accepted offer today, like call me today. Yes. We have to get going on this.
Yes.
Right?
Yeah. I mean, if we have an accepted offer, we're literally locking in right away just because we don't want to risk,
right.
going up 3/8 of a point the next day. It's
Can
a big difference.
Like layman's terms, that lock-in concept, like just how that works? Because I don't think that's fairly obvious for everybody in terms of like, okay, if I have an accepted offer today and I close 2 months from now and the rate's 2 points higher at that point, am I screwed?
Right. So typically you would get an accepted offer, and as soon as you have a contract, it's been signed by everybody, you can lock in immediately as long as you have like a property.
Yeah.
I mean, there's different rate lock periods depending on when your closing date is, but the average rate lock period is about 60 days.
Okay.
So once you go to contract, you are locked in and protected at that rate.
So you want to hurry up and lock it in, not wait 2 weeks to get going into it.
Yes, okay. Absolutely. There are certain circumstances, as you know, sometimes there's delays with closing, but you can also extend the rate if you need to. So if you're going to close 2 weeks past your original close date, there are options to keep the rate.
Cool. Good deal. Can we talk a little bit about, okay, let's get real now and talk about like what the differences actually look like roughly. I mean, as a, CYA statement, like none of this is, set in stone, so to speak, or, don't go to your bank that you're working with and I heard this podcast and, I'm supposed to be at this payment, right? But
right,
just rough numbers in terms of, where we were a year ago, what we're looking at now with certain ranges of rates. What's the difference in payments? Yeah, so just like you said, for demonstration purposes, not quoting a rate, I'm just using these as an example. But let's just say $200,000 price. Would you say that's kind of like average? Yep. So $200,000 price, minimum down payment, which would be 5%. So you're borrowing $190. Okay. Last year, if you were at 4%, in just your principal and interest, not including taxes, that'd put your payment somewhere around like $908. Okay.
Now, say you're at, call it 7.375%, it's probably about $400 more.
Okay. Okay. So there's a tangible difference. Like, this is real money. This is $400 a month, $5,000 a year almost.
Right.
So that adds up, and that's an effect on budgets. I don't know. I personally, I always go. So the conversation I'm having with clients around this is, okay, sure. If you were only financially comfortable to buy a house at that $900 payment, don't stretch it to $1,300 now, unless you can. So all that matters is like you're going about this search for a new home. Step one, what are you financially comfortable with?
Right.
And that monthly payment is a massive part of that, because if you're not comfortable with a monthly payment, like it's gonna, if you have all the cash in the world, even it's gonna cut into that,
Right.
to where it could be detrimental.
Yeah.
So just establish that monthly payment. Maybe the old, last year was $900 your payment. Maybe you're comfortable at $1,200. The 900 was like bonus territory because the rates were so low,
Yes.
right? Maybe you are comfortable at 12 or 1,300, and that's just okay. What price range should we be operating off of at that 1,200
Right.
max,
Right.
as an example?
Yeah, I mean, even when I pre-qualify people, the first step obviously in getting pre-qualified is you want to know how much you can afford. But we always ask people, well, what are you comfortable spending? And when the rates were so low, people were actually surprised, like, wow, I could afford that much. And it's
Right.
because rates were so low. Right. So they might say, like, we're comfortable spending, $1,800 a month. And I would say, well, really, technically, you can go up to like $2,300. And they were surprised at how much of a house they can actually get. So
Sure.
now with rates, going up a little bit, people just have to come back down to,
Yep.
like you said, where they're really comfortable.
And our approach is aligned, and that's why we work so well together, is that like that's the conversation I'm having with buyers too. It's like, hey, call Lisa, but before you do that, sit down, family planning, whatever, like go through the life budget, figure out your expenses. Mm-hmm. Here's where housing fits in. If you're buying for the first time, keep in mind, you don't have the landlord to call, whatever the scenario is, like budget for maintenance, whatever it's going to be per month, whatever, however conservative or aggressive you are from a financial planning standpoint, right?
Right.
And then take that to Lisa. Tell her, I want to be $1,200 a month. I've got 20 grand saved, whatever those numbers are. And that way she just knows right out of the gate, like, okay, yeah, because I find a lot that person who's saying they're comfortable at $1,200, they may be approved up to $2,000.
Sure.
And I think most, I shouldn't say most, but the reason you're great at what you do is like, you're not going to let that person, get to that point without like some serious consideration type of thing.
Right.
Just like, hey, you're telling me you're at 1,200, you want to be there. Sure, I can approve you up to 2,000, but is that really what you want? Like, is this the right move for you financially?
Right. And kind of going into it with that approach, I think that's why, we kind of talked about whether or not there is like shell shock with the rates going
Right.
up for the buyers already out there. But when we're initially pre-qualifying them and we're talking about like your budget and where you're comfortable, a lot of people really are a little bit conservative. Not everybody's, pushing to the max that they qualify for. So even though we're updating these pre-quals from maybe 4% to 7%, people still qualify for that same price point because they were being conservative. They were figuring out where they're comfortable, and there was still, room to go up a little bit.
I just got some encouragement from that in terms of like my fear for any doom and gloom scenario moving forward is that everybody who purchased in the last few years was too aggressive to the point where things don't work out in the next couple of years.
Yeah.
And then they're having to sell in a down market. And yeah, they could be out their equity. And they're having to sell mainly because their payments are too high. So that's good to hear that, and I know I'm paraphrasing you, but like most people didn't just take, oh yeah, you mean I can qualify for $4,000 a month? Let's do it.
Right.
Even though they only want to spend $2,000.
Right.
Because that's just a recipe for disaster, right? Like
Exactly.
That's where like things go wrong. If I had to predict of like, okay, does the market bottom out? Are we in a bubble? This and that. I think that if the majority of the market is in that scenario, then yeah, we could be, especially as, the economics of things play out with inflation, higher pricing on everything, God only knows what's going to happen economy wise. So,
Right.
yeah, that's, as an aside, like, kind of fuels my logic of why we're not in a bubble. Overall, like, people are making conservative financial decisions and knowing that a home isn't a pair of jeans or a car that you can't just trade in,
Yeah.
easily.
I mean, I would say for the most part, yeah, a lot of people, budget ahead of time. They are a little bit conservative, but then you do have buyers who want to push themselves to the absolute max they can. So the rate increase maybe does impact their buying power.
Sure.
So
And
it's something to
so
be conscious of in this market.
the sticker shock then is probably going to come more so with that approach. Sticker shock will come more so like, okay, here's my price point for a home now in comparison to what it was last year.
Yeah.
And that, in this example, rough numbers, I mean, we may be 200 down to like 150, right?
Right.
So now if you got excited about $200,000 homes, I mean, the market hasn't adjusted, and I don't really think it's going to that level where, prices just drop off a cliff.
Right.
Don't get me wrong. I think part of just overall economics and supply and demand and all that and cycles and everything, like, I think there's going to be a corrective period with pricing, but just coming off the peak.
Right.
So
Yeah, I would agree.
And meaning, like, if you got excited about that higher priced home and now you can only afford much less, you're either going to have to find a new way to get excited or, I don't know, right? I mean,
Right.
it's just, that could be where the disconnect is. Because I think there's almost like it's disproportionate, right? Like what the rate now translates to for the same monthly payment at a lower rate in terms of that price.
Right.
Like, is going to be much, like a steeper decline in comparison to like how prices come down when they do.
Right.
It's my thoughts anyway. So there's options to combat this. And what I love about what we're about to talk about now is like, I didn't come up with this, like, learn this, right? But it's like, okay, how do we approach the market with some creativity? It's kind of, the seat that I sit on. And, I called you one day. I'm like, hey, mortgage rate buy downs is essentially what we're going to be talking about in large moving forward here. So I called you, if you remember, like, hey, is this like, am I okay to market this? Like, are we good to get this out there from you, not stepping on your toes type of thing? And like, we're already doing it. You told me, like, we already do it with everybody, no matter what, and 99% of the people take advantage of it.
Yeah. Yeah, so you're talking about discount points.
Yep.
Most buyers have no idea what that is until we actually have that conversation. Like you said, we talked earlier, you go to contract, you lock in a rate. That's our initial conversation to kind of lock in. And at this point, we are talking about discount points. So what is a discount point? It's basically a one-time fee that the buyer pays at the time of closing that reduces the overall interest. So it reduces the interest rate. Most people don't know that you can do that. And anytime we do give the option, they're like, yes, absolutely. I mean, of course, if you have, the extra money to do it, but if you do, it's definitely worth it.
Well, let's take a time out and just address, like, most people don't know about. We haven't had to flex this muscle, so to speak, in the last few years because the rates have been historically low.
That's right.
Question for you, honest question on my end, like, if there was a point when we were at high twos, right? Could a buyer still buy down that rate, or is there?
Yeah. Yeah, they could have, but then it really didn't make sense.
It's not going to be enough.
Yeah,
right?
because it just, you kind of have to do the math and figure out, like, well, what am I paying for the point? How much of a rate reduction is it? How long am I going to be in the house? It just, like you said, rates were so low.
Conceptually speaking,
it
like,
didn't
why
make
would I
sense.
throw more cash at something when I'm already at a just obnoxiously low rate to begin with?
Exactly.
So yeah, we haven't, and I mean, most buyers aren't in the market like every single market cycle, I guess, at 2, 3, 5 years at a time, right?
Right.
So yeah, it makes sense that like buyers are coming from this. I was like, oh yeah, Well, yeah, I want a lower interest rate, and it's only going to cost me. I'll let you get into the examples of explaining how points work and stuff, but
Okay.
like I think it's a no-brainer.
It is a no-brainer. I don't think I've had anybody say no. Yeah, when I give them the option, they're like, absolutely. If we can do that, like, how many points can we pay?
Right. Yeah.
But again, like, it has to make sense. So, just kind of
Yep. Rough numbers.
blanket rough numbers. Let's just say the rate was, call it 7.375 today.
Okay.
So 1 point typically maybe could buy the rate down about 3/8 of a point.
Okay.
So you'd maybe be looking at 7%.
Okay.
So back to our 200,000 purchase price, 5% down, you're borrowing 190. 1 point would be an additional $1,900 to close. But again, it's dropping your rate.
It's a point of the loan balance,
Yep.
not the purchase price. So
Correct.
that's 1,900 instead of 2,000.
Yep.
Okay.
And so back to this scenario, if we're talking about, the difference between that 7.375 and buying it down to 7%, it's probably about $80 difference a month just for paying the $1,900. So it's worth it.
So I'm doing the math. 2 years in that home, you recoup that cost, right? Less than 2 years.
Yeah. Yeah. And
You
then
pay 1,900 to get a lower rate that's going to reduce your payment approximately $80.
Mm-hmm.
80 times 12. Yeah.
and then just overall interest, in
Right.
general for
Right.
the
Yeah,
term.
yeah,
or-
yeah, not even talking about the interest
right.
savings. Right. Yeah. It makes sense if everybody would be in this category. And especially back to like our market,
Mm-hmm.
right? When we're talking about $1 million loans or, higher loan amounts, and you're talking $5,000, $6,000, $7,000 for a point.
Exactly.
Little different.
It's not always going to make sense.
Yeah.
That's why it's best to kind of, talk with your loan officer, make sure they're talking to you about discount points and walking you through the math. Like, well, how much would I save a month? How much, would it be over 3 years, 5 years, 8 years, and make sure that, when am I going to recoup it? Does it make sense?
Do you find that in higher price points here locally, the interest wanes a little bit just
Yeah.
because it becomes, $5,000 compared to
Yes.
two? Okay.
Yeah. I think in the higher price points, buyers are, first of all, if you're buying, let's just say a $500,000 house, you're probably not that worried about payment as much as, somebody in a lower price point. So to them, it doesn't make sense to throw, $10,000 down to pay 2 points for however much.
Yeah.
They're fine with the payment as it is.
Right. Makes sense. Okay, cool.
So, and then, the other thing that people always ask is like, well, what if I paid 2 points, 3 points,
Right.
when does it not make sense
Yeah.
anymore? So on the same example, we were talking 7.375, 1 point possibly buy you down to 7. 2 points would probably get you into the sixes at 6.75. So then that maybe drops the payment almost $100
So we're about half
from,
a point at that point.
so, well, you'd be right, yep, and then you'd be 2 points. So on our 190 loan amount, you're $3,800. So after that, after 2 points, I personally don't think it makes so much sense. Like
Do
you
you
said,
have the monthly payment difference
yeah,
at 2
it's
points?
about $96 from where we
Okay.
started.
So you see that, so you're going from 80 only to 96.
Right, yeah.
Okay.
And then, once you pay 3 points, it really doesn't make sense. I mean, then maybe the rate only drops an eighth versus where we were talking 3/8 or.
And now you're almost $6,000.
And then you're
to
almost
do
$6,000.
it. Yeah.
So usually, to me, I think 1 point is the sweet spot.
Can
where-
you do half point increments?
Yeah, you can.
Okay.
You
Okay.
can.
Yeah, honest question. I didn't know. Okay. So you can't, in this example where we're talking roughly 7 and 3.75 is what we've been using. Like, there's not a way for me to get to 5%.
No,
Right. Okay.
no, not even
So you can't just
available.
throw an endless amount of money and have a much lower interest rate and a monthly payment down there.
Exactly. I
Okay.
mean, you're probably looking at lowering it 3/8 to a half a point,
But
which is still significant.
we just talked about 2 years, not even with the interest.
Mm-hmm.
It takes 2 years to recoup that cost. Mm-hmm. And again, for our market in this example, on average, we're talking a couple $1,000s,
Right.
give or take. No brainer.
Yeah, I think it's a no-brainer, and I think all the buyers that I talk to, think it's a no-brainer.
And we're locked in at this point. We're talking about fixed rate mortgages.
Yep. So this would be a
So the
30-year
rate you
fixed rate.
the rate you buy down to, there's no changing it.
Right. It's for the life of the loan.
So, and you can refinance if the rates drop significantly or if it makes sense to.
Right.
So there's nothing that buying points, these discount points, it's nothing that like causes any stress, so to speak, on the back end. There's no fine print to this. It's
Right.
like, you're going to end up wishing you didn't do this.
I mean, but like we said, not every buyer has like extra cash to do it.
Sure.
They're already, they have 15,000 to work with, and that's it. They don't have an extra 2,000 laying around.
And that's a total, that's also kind of a symptom of our market in terms of our price points is like, we're not dealing with the average $1 million buyer in Los Angeles or whatever it is, right? That
Right.
has X amount of cash in order to do that. So this is a totally practical conversation. Now, here's like where the world of opportunity opens up from my viewpoint. Is, this market is cooling and shifting. Like we're still in this seller's market, which again, we've beaten to death on past episodes too, right? But there's just going to be more and more opportunities for listings that don't sell to where haven't heard the term seller concession in a while, right?
Definitely not.
Now, and that used to be before, call it 5 years ago. Totally common thing.
Yeah.
Like
Very common.
And so just to define seller concession, a seller is allowed to pay a portion of a buyer's closing costs.
Correct.
Contractually, legally, whatever you want. Like it's all above board, can be allowed. For FHA loan product, up to 6%
That's
of
right.
the purchase price. For a conventional product, up to 3%.
Correct. And possibly even higher depending on the down payment.
Sure,
But yeah,
right.
those are kind of the average
Yep,
thresholds.
without getting into the weeds, yep. So like $200,000 price point, conventional loan, 3% max. A seller could, in theory, contribute $6,000 towards a buyer's closing costs.
Right.
Up until now, in my career of 10 years, seller concessions were always just, and maybe it happened on the back end where I just didn't realize it, but seller concessions to me were always commonly like, okay, you'll reduce your cash required at closing.
Mm-hmm. Yeah.
Because the rates were low, right? So
Right.
it's like, why buy the points when the rates are already low?
Yeah. And I mean, in a market, like you said, where buyers were getting seller concessions, it's because they needed them. They needed every penny they
Right.
could to
To
get
make-
to the closing table
Yeah.
to, be able to purchase the home.
Because even before all this craziness with the seller's market happened, excuse me, I mean, to get personal, like my rate's 3.875.
I think that's what mine is.
Bought in 2017, like at the start of this. Like it was still not extreme at all.
Mm-hmm.
But at the start of all this, I'm trying to think, I mean, in the fives, like the early part of the decade, I think after the last recession, 2008, we bought our first home in 2008. I think we were at 5.
I think high fives, low sixes.
Okay. So then it just started to come down from there.
Yeah.
So like,
I think I bought my house in 2012 and we're in the threes.
yeah, so it came down quickly.
Yeah.
So we've never had to have this conversation of like, hey, you should buy a discount point to lower your interest rate because, I mean, part of it's perspective, right? With like the old, my parents bought at 16% in the 80s, so you're doing all right at 4,
Yeah.
right? But it's just the incentive's already there because the rate was low. Mm-hmm. Now, rates are, comparatively speaking from the last few years, obnoxious. So like, let's find an incentive to get it lower to your benefit. Mm-hmm. And the benefit is huge because we're not talking about significant amount of dollars. Okay,
Right.
Back to concessions. Mm-hmm. All that rambling was essentially to say it used to just be, on a $200,000 home with 3% concession, you're showing up to closing with $6,000
Less. Right.
So if you owed, $20,000, you can buy that home with 14.
Right.
You're paying for the home $6,000 more in theory, right?
Yeah.
But showing up with less cash. I can see a benefit to that.
Right.
Now you got $6,000 to go, whatever, put new windows in or whatever, right? Concessions, I mean, the language of a concession is to go towards lender prepaid costs and items or something like that.
Yeah, so closing costs and then what prepaid items are basically like property taxes, homeowners insurance,
Right.
prepaid interest. But yeah, so essentially if you're getting that 3% or, 5% concession, it goes towards that bottom line of what you need to close.
Okay.
So it typically comes off like the closing costs.
So we can use a seller concession contractually to help with, not even only help, but in this example where you're saying it doesn't really make sense to go above 2%. So you get a full 3% seller concession. 2 of it can go towards the rate buy down, and then another 1% can be less cash out of pocket.
Yeah, just less cash out of pocket. Or like you said, we are, having to get a little bit more creative. Buyers, again, back to talking about like budget. They really want to feel comfortable with a certain payment. So we're talking about how do we get you there?
Yeah.
Buying the rate down. You just mentioned 3% concession and maybe using 2 points to buy the rate down. Another thing you can do that a lot of people aren't really aware of is you can PMI, we'll talk about that real quick. So private mortgage insurance, basically an insurance that you pay monthly that protects the bank in case you default or foreclose.
Yep.
On our, scenario, we're talking about $200,000. I mean, it could be $60 a month. So what you can do is you can actually pay for a policy in full and not have the monthly PMI.
Oh,
So that
okay.
that could essentially cost 1%. So you could use 3%, you can use 2 points, buy your rate down, and then you can use the other 1% to get rid of your PMI monthly, which knocks your payment down another approximately $60. So you just got to get creative with the financing to get you in that comfort zone.
So in that scenario, we've just talked about, so we started off talking about potentially a $400 higher per month. We just knocked the rate down paid 2 points to knock it down approximately half a point, which translates to approximately, call it 100.
Yep.
And another point to go towards the PMI waiver or upfront payment of it, that knocks it down another $50.
Could be even
So
more.
we just brought $400 down to $250 more.
Right.
And we're still in the same price range. We're still in this high climate of high interest rates, and we just created a $150 per month win.
Right.
The opportunity that I'm talking about is like this market is going to continue to cool and shift, and we're already seeing it with homes that aren't selling with the bidding wars. Those sellers are like, if I'm the listing agent, it's, hey, don't panic. We're on week 2 now. No big deal. Like, I have to continually offer the perspective of like, hey, and I realize perspective doesn't always do good, right? But just like, keep in mind, we used to just be, it would take 60 days to sell a home on average,
Yeah.
right?
Yeah.
So like sellers like, oh my God, we passed delayed negotiation. We didn't get a bidding war. We're stuck. We're screwed. It's like, no, just relax.
Right.
We're on week 2. We're going to get another phase of marketing out there, which is super effective because we can then, hey, it didn't sell. There wasn't a bidding war. Get in this house. We're at our asking price. Sometimes a bidding war even happens after that for a seller, but we're still here. Come buy this house.
Right.
That usually works. It's if a property is grossly overpriced, like we're still in this market where there's more buyers than there are homes for sale. So a property has to be something wrong with it or an obnoxious price tag on it to not sell at its list price or pretty darn close to it, if not more, in a quick time period. And I'm talking quick in 2-3 weeks max. If 2-3 weeks goes by and then you don't have anything, then okay, we're probably looking at something going on or we need to reduce the price.
Right.
Before you reduce the price, well, from a buyer perspective, get your butt in that property and make an offer with 2%, 3% seller concession to buy your rate down, or just understand, period, you could buy the rate down with a couple,
Are you guys seeing, like with all your listings and offers that you're getting, is anybody asking for concessions anymore?
No, because we're still selling these listings with competition.
Yeah.
Like I just literally this morning, there's been one listing that I can't get off our plate. and it's been 30 days now. I'm telling us that, like, you got the scarlet letter on you right now, man. We got to do something. So, and he's, hesitant. And so I finally convinced him we're going to do a slight reduction. And he's given me the permission to market on the listing, seller willing to provide a concession to, help us sell a buyer at a lower interest rate.
Right.
Whatever the language is going to be.
Yeah.
It's all that word willing is just marketing, right? It doesn't tie the seller into anything until we get a contract. But yeah, to answer your question, we're not having a lot of trouble with not selling listings right now. It just speaks to the market.
Right.
The friggin' rate being what it is. Like, if you would have told me this a year ago and that I'd be saying what I just said, I would have told you you're nuts. And B, we're in the fall, our most seasonal time period. And we're still strong market for sellers.
I would agree.
So, but the opportunity is going to increase for buyers that either, want to take advantage of not getting into bidding wars or want to take advantage of them not paying points and having the seller do it.
Yeah, or, I can't even think how many buyers in the last couple of years, that I would speak to about getting pre-qualified. They have the credit, they have the job, they just don't have enough money. And they knew that seller concessions were impossible. So those buyers are still out there, where maybe they decided to rent because they just didn't have the money, they're saving. But yeah, if there's opportunity there for them to get concession, there's a whole slew of buyers out there that, could potentially get back in the market.
Well, and so the message to the buyers is like, listen, the 10 out of 10 shiny penny new listing that's got just listed today and delayed negotiations till Monday, and we can see there's 75 showings scheduled on it.
Yeah.
And maybe 75 is extreme right now with this market, but 30, 40, is still very common. So there's still 30, 40 buyers out there for some of these listings, right? Meaning the market is still saturated with buyers.
Yeah.
So, that's probably not going to be the opportunity I'm talking about. But you got to get real analytical or real selective, whatever you want to call it, in terms of what to pursue and know that okay, this house didn't sell. It's sitting out there. Why wouldn't a seller, if they're having trouble selling, take an offer 3% less off their asking price? And hey, if you're a buyer, if you can even do more than that and negotiate this and that, those days are coming again. There hasn't been much negotiation on a buyer end other than, how many of my kids do you want to keep or whatever, right? So it's just your opportunity is going to strengthen as time goes in the next, however long this lasts. But I mean, I'm a believer in market cycles, so I think we're, whether we get to a buyer's market anytime soon, I have my doubts just because of inventory. But if we can get to balance, then there's the one house that sells very quickly with a bidding war, and there's the one house that doesn't.
Right.
Buyers, that need this help, so to speak, focus on that house that isn't selling.
Right.
Be practical. You're not probably still, market hasn't changed where you're probably still going to be able to get the, newly remodeled kitchen or whatever, right?
Yeah.
But that doesn't mean you have to buy a piece of crap or whatever.
Right.
So it's just and this conversation that we're having creates a win for both sides.
Yeah, it does.
Huge win for buyers, obviously. Just even if the seller's not paying for it, get yourself in the market, know how to have a lower rate than what it is now. Why wouldn't you if you can? And for sellers, for listing agents, get creative with this tactic.
Yeah, just like we're having to kind of get, creative with the financing. So now, we're talking about buying points down. There's also ARMS products available.
I've heard that in a while.
Yeah, no.
I haven't dealt, 10 years.
Yeah.
Haven't dealt with that ever on my end.
It's been a long time since we've,
that just
probably about 10 years.
We talked about it earlier in terms of the rates have been no higher than 5 or 6 since I've been doing this since 2012.
Right.
So there's why would you do an adjustable rate?
Right.
An ARM is an adjustable rate mortgage. Why would you get into something that's not fixed at a super low historic perspective interest rate?
Right. But yeah, for somebody now, if you're, looking at something in the mid 7s, So you can do a couple different types of ARM products. I mean, there's ARM products where it's fixed for a certain time period. So say maybe 5 years or 7 years, and then it starts to adjust after that period is over.
Okay.
So that could start you off with a lower rate. I mean, that might be a good opportunity to kind of see like, okay, what happens, our rate's going to come back down over that time period where we can maybe like refinance down the road.
So you're gambling.
Yeah, you'd be gambling.
So what rough numbers on how these products are playing out right now? Like if we're fixed at 7.375 roughly 7.5 right now, like what would the lower end of the arm be currently?
Probably in the sixes.
Okay.
But again, like people aren't really comfortable with, ARM products. I've maybe sold, a couple buyers that have done it. To them it was worth it. They're willing to kind of see what happens, over that time period. But most people are just really comfortable with like a fixed rate. But when you're talking about like the seller concessions and maybe the, seller offering that and the buyer using it towards points or whatnot, you can also do something called like a 2-1 buy down. So let's just back to our 7.375 that we're using as an example. So basically your first year, the rate would be 5.375. So you'd have those lower payments for the first year.
5.375. So buying down two.
2 points, but it's just for the first year. Then
Okay.
year 2, it would go 6.375. Then year 3, it goes 7.375. So to do something like that, there is a cost associated with it. But again, the seller could, pay a concession to kind of go
And then
towards
you're
that.
fixed at the end amount? The
Yeah,
7.375
then you're fixed at the
for
end
30
amount.
years if you're doing a 30?
Yeah, so some of these ARM products that, like you said, we were selling, 10 years ago, people are asking, well, what would it take me to get the rate into the sixes? How can I get there? And these are the conversations we're having, talking about different options.
Now, an arm can be to the benefit where if when it's time for it to adjust, if the rate's lower, you gambled and won?
Yeah.
Okay.
Could end up lower,
Or it could
or
be
you
10%.
can refinance down the road. Rates
it.
come back down into a lower fixed rate.
Well, and all of this is relative to each situation. And I think, the comment you just made about refinancing applies across the board. And it's just like, we talked about it recently on one of these shows, and it's something I've been talking with our agents about a lot, is like there's a lot of these cliche statements going on, or they're becoming cliche.
Yeah.
Marry the house, date the rate.
Right.
Right? Like, my approach is like, if you just tell a client that and don't fully explain it, you're an asshole.
Right.
Because this is intense times right now. Intense financial, just everything going on in the world is intense, right? So if you're just throwing out sales lines, right, to try to convince somebody and not fully explaining it, you're an asshole.
Right.
So, to be blunt. But if you take the approach of, hey, you probably heard this term or saw the meme or whatever, right? But here's what it means. Like, if you're really in love with this house and you're at this rate now, and we're coupling it with, buying it down to get it even lower, if it makes sense. Well, two things. One, you're protected that if you need to make a move because your family's growing or whatever it is in the next year or two, and God forbid the rate goes significantly higher and you're at 10 or 12% at that point, you're screwed. Mm-hmm. You may not even be able to do anything.
Yeah.
Because we just talked about the scenarios in play now, and now you're an extra $400 on top of that, right?
Yeah.
So that's painful. But if you're at that rate, you're winning, perspective-wise. Or if you're marrying that house, that piece, and you're loving it, and this is as much as you can predict the forever home, and the rates drop to 5, and you're, again, remaining in that forever home is the plan, refinance.
Right.
Because the savings will be there at that point, right?
Oh,
The
absolutely.
savings will be there, and there's a cost-effective way to do it.
Yeah, and with the way our home prices have kind of been going up over the past few years, so many people took advantage of refinancing. It just was a no-brainer. I mean, they have the equity now. You can roll in all the costs. So the process of a refinance is kind of similar to when you're purchasing. You're just, taking out another mortgage. You go through the loan process. You close. You get a new rate and new payment.
And now back to, the examples I play, maybe $400 less
Right.
on your payment. And who knows, at that point, you may even have equity to where you may do, you may take some money too from it,
Yeah.
right? So, all right, good stuff. I mean, this was huge to get you in here to really talk numbers, to really talk options. Not irrelevant, but like we're already doing this with all of our clients anyway. But it's like, I think if anything, don't just look at the news out there as a consumer and just decide without consulting with anybody. They're like, oh, can't do it.
Yeah.
Not going to work. Like, don't get me wrong. Priority one, staying in that financial comfort zone, sure. These higher rates may bump you out of that conversation. Mm-hmm. And then our advice is going to be like, I'm not here to sell you a house to where like you're going to be strapped. And like the last thing I want is you have to call me a year later having to sell that same house because there's financial pain. That's no matter what the market is.
Right.
Could be really dangerous coming up. So, but yeah, I mean, it's good for people to know that they have options and it's not just like,
Right. Here's the rate.
set in stone and that's it. Because I feel like that's been a lot of the market for buyers. The rates have been low, but it's just like buyers have had to take it on the chin the last, handful of years.
Right.
Hopefully that's changing.
Yeah,
Other
absolutely.
than the rate being high. So, good stuff. Anything else that we didn't cover?
I don't think so.
This was awesome. I appreciate you coming in.
Thanks for having me.
Lisa Roberts, Premium Mortgage. Jason Mancuso here, as always, with the Anthony Butera team. Thanks for tuning in, guys.